All right, let's jump right in. Today's explainer shifts our perspective on institutional finance to tackle a massive, multi-trillion-dollar question. What risks do insurers actually need to manage on the asset side? If you think managing an insurance company's war chest is just about trying to beat the stock market, well, the reality is a whole lot more complex. So, let's get into it.
Will asset prices go up or down? I mean, for a retail investor or a day trader, this is it, right? This is the holy grail. It's pretty much the only question that seems to matter. But if you're an insurer sitting on billions of dollars of premium capital, treating the market like a simple guessing game of up or down is incredibly dangerous. Investment risk for these guys goes way, way beyond simple market volatility.
It's a complete paradigm shift. The simple view isolates the market, but the actual insure mandate is an entirely different beast. You see, an insurance company's investment portfolio doesn't just exist in a vacuum. It's deeply, intrinsically tied to long-term obligations to policyholders, daily liquidity needs, and some very strict capital requirements. The real question the professionals are asking is, how is this portfolio going to behave under a complex web of market, credit, liquidity, and liability-driven scenarios? To truly wrap our heads around how insurers navigate all this, we're going to explore 6 critical dimensions today. 1. Beyond the market casino. 2. Market and credit pressures. 3. Liquidity and concentration blind spots. 4. The Asset Liability Balancing Act. 5. Internal operational threats. And 6. Redefining insurance investment risk. Okay, starting with Section 1, Beyond the Market Casino, understanding market risk beyond simple declines. When we talk about market risk, we're usually thinking about the usual suspects, right? Interest rates, equities, real estate, foreign exchange. But for insurers, the stakes are totally different. A simple market decline in equities isn't necessarily their absolute worst nightmare. The real danger is how interest rate movements independently impact their assets compared to their liabilities. Just imagine for a second that rates move and your asset values drop, but at the exact same time, your liability obligations shoot up in the completely opposite direction. That is the real market risk for an insurer. It's about how these moves impact solvency, capital, and that delicate balance of assets to liabilities.
Moving right along to Section 2, Market and Credit Pressures and the Reality of Fixed Income Portfolios. Because insurers have strict obligations, they aren't just dumping their cash into high-growth tech stocks. They hold massive fixed income portfolios. But let's look at conventional credit risk versus insurer credit risk. Most people think credit risk just means a company goes bankrupt and a bond defaults. But for an insurer, it's not just about defaults. It's about rating migration, credit spread widening, and the deterioration of issuer quality. A bond might literally never default. It might pay out exactly as promised at maturity. But if there's a massive spread widening or a downgrade today, it instantly creates intense valuation and capital pressure for the insurer right now. It's a much heavier reality. Which brings us to Section 3, Liquidity and Concentration Blind Spots. These are the hidden portfolio pressures.
First up here is liquidity risk. Now you might be scratching your head thinking, wait, don't life insurers have liabilities that don't pay out for 20 or 30 years? Why on earth do they need liquid cash? Well, they desperately need it because they have daily claims, surrender payments, collateral needs, and completely unexpected cash outflows. And this risk gets magnified enormously if their portfolio is packed with private assets or complex structured products that are nearly impossible to sell in a panic without taking a huge haircut. And then we have concentration risk. This happens when seemingly diverse assets are secretly exposed to the exact same underlying risk driver. This isn't just a rookie mistake like, putting half your net worth into one stock. An insurer's portfolio can actually look incredibly well diversified on paper, holding hundreds of different assets, but still be critically vulnerable. Just think about the hidden drivers here. You could hold a great mix of equities, bonds, and real estate, but what if they are all tied to the exact same region, or the same sector, or even the same counterparty? If one domino falls, the whole stack comes down. Multiple totally different assets could fail at the exact same moment if they rely on the same underlying liquidity conditions. That's the hidden blind spot that keeps risk managers up at night.
All right, we've reached the absolute heart of the matter. Section 4, the Asset Liability Balancing Act, the internal core of risk.
Up to this point, we've basically been talking about evaluating assets. But for an insurer, looking at an asset in total isolation is basically useless. It absolutely has to be assessed against the liability profile. It's a rigorous sequence. Step 1, do the asset cash flows actually match when we need to pay out liabilities? Step 2, is the duration gap acceptable? Step 3, how sensitive is this specific setup to interest rate changes? Step 4, do the profits from these assets actually cover the costs coming from the liabilities? And finally, Step 5, does this guarantee our long-term solvency? This process, asset liability management, or ALM, is the central nervous system of an insurer. Without this balance, the whole shebang falls apart.
Okay, Section 5, Internal Operational Threats, where process discipline matters.
This is fascinating because we spend so much energy stressing over what the Fed is doing or what the markets are doing that we completely forget risk isn't just an external thing. Risk can just as easily come from inside the house. We're talking weak internal controls, terrible data quality, flawed financial models, basic valuation errors, or just not having an effective escalation plan when someone actually spots a red flag. A robust risk framework isn't just some dusty PDF manual. It has to make risks measurable, monitorable, reportable, and actionable by the people steering the ship. Process discipline is literally everything.
Finally, Section 6, redefining insurance investment risk through the professional perspective. Let's look at how the real pros talk about this.
I want to read this directly because it absolutely nails everything we've been talking about. A true pro doesn't just say, oh, we manage investment risk. They say, we monitor asset-side risks across market, credit, liquidity, concentration, operational, and asset liability dimensions. The goal is to understand how the investment portfolio may behave under different scenarios, and whether the risk profile remains aligned with the insurer's liabilities, capital position, and risk appetite. I mean, that is a massive difference in perspective, isn't it? It directly connects risk to actual portfolio resilience.
And that leads us to a fundamental truth. Risk management is not just a defensive measure. It's not the compliance police showing up after the fact to slap your wrist. It is a highly active, fully integrated part of daily investment decision-making. The goal isn't just spotting the risks, it's aggressively managing them so that decades from now when someone actually needs their claim paid, the money is fully there and waiting. So I'm going to leave you with this provocative thought. How robust is your organization's definition of risk? Are you still just asking if the market is going up or down today? Or are you looking at the entire iceberg, the liabilities, the liquidity blind spots, the internal operations? Because once you understand this framework, it really changes everything.